All right, folks, listen up and buckle up, as the S&P 500 and the Nasdaq are about to make a big move that many traders aren't positioned for. So let's get started. Right now, SPY has done a 5% run off the November 21 low and is coiling in a 60-minute diamond pattern between roughly 678 and 684, sitting right on the biggest volume node of the entire swing. That is an indecision box at a statistically stretched location. Until we leave that box, I would not be adding risk aggressively in either direction. Seasonally, the S&P 500, also known as the SPY ETF, often spends the first half of December wobbling or pulling back as funds rebalance, harvest tax losses, and clean up books into mid-month, the Santa rally effect. The Santa rally effect tends to kick in after mid-month, especially the last 7 to 10 trading days, when positioning is lighter and New Year optimism starts getting priced in. For calls, I'd want either a proper flush into support or a breakout that proves this diamond is continuation instead of distribution. The first place I'd get genuinely interested in adding calls is down near the 671 to 673 band, which is where the 38.2% retrace of the November 21 to the December rally lines up with the rising 60-minute 50 MA. For puts, I would treat the current zone as a place to stalk edges, not chase red. My first put add zone is 683 to 684 itself. Each time we've probed that area, we've seen sellers step in. If we push back into 683 to 684, print rejection wicks on the 5-minute with RSI failing to get through 60, I'd be comfortable taking a tactical put position there with a stop above 684.50, targeting a move back to 679 to 678 and, if the box finally breaks, down towards 673. On the higher time frames, SPY is still wearing a bullish jacket, but on the intraday view it is pacing back and forth in a narrow hallway, deciding which door to walk through next. The daily, weekly, and 60-minute charts together tell a pretty coherent story for the next few weeks if we translate them carefully into triggers and targets. If you'd like to join our live options trading room for free, just tap the Patreon link below for a 7-day free, no-obligation trial. Starting with the weekly chart, the trend remains firmly up. Price is holding well above the rising 50-week moving average and is consolidating near the top of the 2024 range rather than rejecting from it. Weekly RSI is in the bullish half of the range and has not shown a meaningful bearish divergence yet. The KST and PMO oscillators on the weekly panel have curled down slightly after a strong advance, which is typical of a pause or mild consolidation rather than a completed top. From a weekly perspective, the path of least resistance into year-end is still sideways to higher, provided that any pullback is contained above the 650 to 660 area. The daily chart refines this into something more nuanced. After the sharp V reversal from the 650.85 low, SPY marched straight into a heavy band of overhead supply and pivot resistance in the high 680s. The last several candles show real bodies shrinking and overlapping, with daily stochastics now pressing into the upper band but beginning to flatten. MACD-type momentum is still negative but trying to curl upward, which is exactly what you expect in the early stages of a recovery from a sharp correction. Price heals first, momentum follows more slowly. Daily RSI is sitting a bit above the midpoint, not overbought, but also not enthusiastically confirming a new leg higher. In short, the daily picture is uptrend but tired, and the market is using time and a narrow range to digest the rally. On the 60-minute chart, the structure is even clearer. Since the November 21st low near 651, SPY has climbed roughly 5% in a fairly linear staircase, and that entire advance has now stalled right at the largest volume profile node of the whole swing. In other words, we've pushed straight into the area where the most recent deal flow between buyers and sellers occurred, and instead of slicing through it, price has started to chop sideways. That chop is taking the form of a textbook diamond pattern at the top of the move. Diamonds are inflection structures. When they break, they tend to break with force, but they don't tell you direction in advance. Thomas Bulkowski suggests these move downward 55% to 59% of the time. Given that this one is forming after a 5% rally into a major node, it deserves respect as potential Wyckoff distribution phase until price proves otherwise. The Fibonacci structure underneath adds a very clean roadmap if the diamond resolves lower. The 38.2% retrace of the November 21st to December swing sits almost exactly where the rising 60-minute chart and 50-period moving average comes in. around 671 to 672, which would be a natural first magnet on any breakdown from the 680 to 684 diamond. So right now, price is sitting 1.19% below all-time highs. My playbook stays. No new swing calls unless we either flush into 672 to 673 and hold, or break and hold above 684 to 685 with real volume. It's okay to stock tactical puts against the 683 to 684 area or on a clean break of 678, with the understanding that you're leaning against all-time highs, not shorting some oversold abyss. The 50% retrace down near 667 to 668 and the 61.8% level in the low 660s then mark the deeper but still technically healthy mean reversion targets if sellers really take control. Conversely, a decisive break out of the top of the diamond above roughly 684 that holds on a closing basis would signal that the pattern is acting as continuation rather than topping, and would reopen the path towards 690 plus in relatively short order. Until one of those edges breaks, though, this 60-minute view is essentially telling you that SPY is coiled at its highest volume node after a 5% run, and the next directional move out of this diamond is likely to define the next couple of weeks. As traders, we trade probabilities. The tape slightly favors a downside probe before any clean breakout. The pattern of lower intraday highs, the softening short-term RSI on the 5 and 15-minute charts, and the repeated failures in the 683 to 684 zone all argue that liquidity is gently tilting toward the lower edge of the box. It is therefore reasonable to expect at least another test of 678 to 679, and quite possibly a stop run towards 676 to 673 over the next week. However, because the weekly structure remains bullish and the daily trend has not been broken, that pullback, if contained above roughly 668 to 670, would still qualify as a corrective move within an ongoing advance rather than a major top. Only decisive closes below the high 660S, especially if accompanied by a rollover in weekly RSI and a clear breakdown in OBV, would justify abandoning the year-end bullish bias entirely. Putting all of this together, the most likely path forward over the next few weeks is a continuation of this choppy, mean-reverting behavior inside and just below the current rectangle, with a mild downward bias toward the 672 to 673 area, if 678 finally gives way. That scenario, aggressive longs initiated inside the box are vulnerable to whipsaw, while patient traders wait either for a flush into the lower support band or for a convincing breakout above 684. If the market can absorb any such dip without violating the high 660S and then reclaim 684 with expanding volume, the stage would be set for a final push toward 690-695 and perhaps a flirtation with 700 into late December. Conversely, a failed bounce from 672 to 673, followed by closes under 668, would shift the narrative toward a larger corrective phase and force a reassessment of upside targets. For practical positioning, that suggests using the 684 region as your add risk line for upside continuation, and the 678, then 672 to 668 staircase as your risk management ladder on the downside. As long as the daily closes remain above roughly 670, your longer-dated upside calls remain logically aligned with the higher time frame trend, even if the next act is a slightly deeper pullback than we have seen so far. That's about it, folks. Give us a like and subscribe if you think we earned it. Until the next one.